Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me from the Bangalore studio is Ritu Singh. These are the top headlines from the startup space. Google layoffs have begun in India. Sources aware of the information told CNBC-TV18 that the tech giant has laid off 450 to 480 employees from various departments in India late night. The employees who were into dotted line reporting or did not have any direct managers have been laid off.
After sacking 90% of its India employees, Twitter scales down its operations even further, shuts down offices in Mumbai and Delhi, continues to operate the Bengaluru office, which houses a few engineers, as Elon Musk's mission to slash costs continues.
Byju's is in negotiations with investors, including TPG, to raise more than $500 million that could help the edtech majors stave off potential debt issues, says Bloomberg News. Byju's is also in separate talks with creditors to renegotiate an agreement governing a $1.2 billion loan that's in breach of covenants, adds the report.
Electric two-wheeler maker Attire Energy is seeking to raise $250 million from current and new investors at a unicorn valuation, Mint reported. The firm aims to secure a post-money valuation of $1.3 billion.
82% of founders say they will strive for profitability and prioritize scaling their startups, while 79% of VCs expressed a focus on profitability and 21% want to focus on growth, as per a new report by Stride Ventures. This is in contrast to 2022, when 55% of VCs and 68% of founders focused on growth rather than profitability.
Neil Mohan becomes the new Chief Executive Officer of YouTube, joins the long list of Indian origin CEOs leading big tech companies. The 49-year-old has previously worked with Accenture and Google before moving on to YouTube.
Snapchat crosses over 750 million monthly active users. The company claims to have grown daily active users by over 15% year over year for 13 consecutive quarters. Snapchat aims to reach over 1 billion people in the next 2 to 3 years.
About $2.5 billion takeout from Binance's stablecoin this week. Binance's CEO said on Twitter, after US regulators' scrutiny on cryptocurrency, most of the money has moved from Binance USD into Tether.
Well, those were the headlines we're tracking for you this evening. Now, from the return of angel tax, probe on unregistered startups, threat of a ban on digital lending apps, and now a government crackdown on online pharmacies, there have been a host of regulatory actions against startups in these past few weeks. CNBC-TV18 has learned that the government may soon move to take legal action against online pharmacies for alleged misuse of personal data and market monopolization.
That's right. We understand that after laying off more than 90% of its India staff, Twitter, unregistered startups are also under the IT department and DPIIT scanner to probe any tax evasion and valuation manipulation. Now, what does this mean for the startup community, and what is the way out of this? We are now joined by a special guest, Siddharth Pai, the founding partner at 314 Capital. Siddharth, thanks very much for being here with us. Let me start by asking you about the burden of regulatory compliance, and that is only increasing when it comes to startups here in India. We spoke about angel tax recently, but now the big question has been, are investors seeking exemption of these tax provisions for certain funds? If you could confirm for us, one. And the second big question is the valuation mechanism. Has the industry reached out to the government on the adoption of international standards when it comes to valuation?
I think that's a fantastic question. So, under angel tax, section 5627B, regulated entities such as AIFs and funds that are regulated by the IFSCA in the GIFT City are actually exempt from the provisions. The rationale for the exemption is because these particular funds, being highly regulated, undergo strict and stringent AML checks, KYC checks, UBO checks, and the like itself. Similarly, just because a foreign funds actually investing into India may not be registered or regulated in India, they are actually regulated by the financial services regulators of their various jurisdictions. Now, most of the AML and KYC checks have actually been standardized across the entire world. If you looked at the largest funding rounds that have happened in India, the majority of the funding actually comes from regulated financial investors from all these jurisdictions. So in case, if the scope of this particular section is to prevent the laundering of unaccounted funds through this, then the same leeway that's been offered to SEBI-registered AFs should also be offered to all these other regulated investors, such that they become an even playing field as part of that. A number of foreign funds have already reached out through various association bodies as well as directly to the government, and the government has actually showed a patient hearing on these particular matters itself. And the other clash that's actually happened so far is with regard to the valuation mechanism. Now, under the Foreign Exchange Management Act of India, it is possible for an investor or a startup to actually have a valuation report with any internationally accepted valuation methodologies. Whereas the Income Tax Act has actually prescribed only DCF, or discounted cash flow method, is the only means of actually valuing these startups. Now, for pre-revenue startups that are yet to actually start monetizing or finding product market fit, most of these DCF, their cash flows only start coming in from year 6 or year 7. Because of the inherent flaws of the DCF model, their valuation actually ends up becoming negative or fairly low. So the ask of the industry is to align the Income Tax Act with the FEMA regulations to make sure there's only one valuation report that you require, and makes the entire process a lot more streamlined and increases the ease of doing business for all Indian startups as well as investors.
Absolutely. Hi, Siddharth. Arundhati here. Now, India has the third largest ecosystem with almost 85,000 registered startups, but many of them remain unregistered till date. So there could be concerns about tax evasion, etc. So what do you think are the difficulties startups face in getting registered, and the reason why they may choose to remain unregistered?
I think one of the reasons why they choose to remain unregistered is they don't meet the criteria stated under the definition.
Right.
In order for a company to be considered as a startup in India, their revenue has to be less than 100 crores, as well as they need to be actually in existence for less than 10 years. And they should have been formed by the merger or amalgamation or spin-off from an existing business entity. So for companies who have actually exceeded the 100 crore revenue threshold or been in existence for more than 10 years, they actually fail to get recognized as a startup under DPIIT. And even all the exemptions to the angel tax under Form 2 and the like that have been issued by the CBDT and DPIIT doesn't apply to any startup that actually has more than 100 crores of revenue. So that 100 crore figure actually becomes a glass ceiling, which is why a number of the startups actually graduate. I wouldn't say fail to get registered, but graduate from the registration and thus actually expose their entire startup to the whole host of angel tax as well as the other issues that are actually affecting Indian startups as of now. Startups are not just companies less than 100 crores, but they actually encompass a wide range of highly innovative companies. And we need to have a definition that actually encompasses all of them, not only the ones that are extremely small or are yet to actually end up having scale or growth.
Okay. So a wider definition for startups to begin with. But, Siddharth, also, there's a fine line between effective regulation and what some would call regressive regulation. With all of these spate of regulatory crackdowns in the industry, is there concern we could be leaning towards the latter? On the other hand, of course, one can argue that regulation is centered around consumer protection. So the idea sometimes is that the regulator slows down innovation until it can catch up with the evolving dynamics. Which part of the argument are you on?
I think this is the age-old clash between innovation and regulation as of now. If you look at what's happening with the e-pharmacy space as well, the reason why most of these companies have actually gotten this notice as of this date is because the regulations were actually written for brick and mortar stores, not for these kind of online players and dark stores itself. Similarly, when we actually gone through digital lending and the like itself, even though the business models are the same, our regulations yet to actually evolve to actually accept wholeheartedly the digital nature of Indian startups. And I think that clash is actually inherent in a large amount of the tension that's actually there. If you look at angel tax as well, angel tax came about in the year 2012 because there was actually certain allegations of money being laundered through high share premium itself. But whereas a large amount of these regulations have been misapplied to Indian startups as of now. So I think given the fact that a large number of our laws and regulations were written for legacy companies, most of them are now being force-fitted onto the Indian startup regime. And that's why we're seeing the entire clash. I think it's important for startups also to get together, go and lobby to the government to say that this was the intention behind the law. This is how it affects our business model, and to work with the government to actually end up creating the kind of change that they want. Going on to Twitter, going on to Coup, going on to social media, etc., doesn't exactly is not the same as forming an association and going to government.
Right.
So I think it's important for Indian startups to also mature, have a dialogue and a discussion with government, and to make sure the regulations come about also reflect their business models. I think that sign of maturity is going to be important. And we've seen the likes of digital lending startups and several others form these associations. I think the more associations we have, the greater the collective bargaining power there is, the more our regulations will end up actually adhering and respecting the kind of business models and innovative models we're seeing come out as of date.
Right. Let's address the e-pharmacy crackdown. There are some prominent names of this list of companies that have been issued show cause notices, and now legal action is being mulled. Is it being seen as an act of exploiting loopholes or avoidance? What kind of a message will this send to startups in this space?
I think the biggest message over there that's being exposed right now is the deficiencies that exist in our regulations. Like I said, all these regulations were written for brick and mortar stores. if you actually see the news reports and all that have come out, they've said that your Schedule H drugs, etc., need to actually be given. You need to get a prescription that comes in place first to deliver the drug, then make sure the money is paid, make sure it actually comes from a recognized pharmacist and the like itself. Now, if all this happens from their go down or whichever storehouse that they end up having, which may not be registered for that matter, that actually is what actually causes the clash. So I think it's important for our regulations to also get updated to the new and innovative models that have come about. E-pharmacies were actually saviors of India when the lockdown ended up actually happening. Even before that also, there was a large amount of friction between them and the government. But I think once the lockdown happened, they were the ones who were actually going about and making sure that life-saving medicines were available to a larger chunk of the population. So I think it's important to build up, not actually forget the role that they've actually played in terms of alleviating the hardship of COVID, and to make sure that the government actually works with industry to make sure that these particular e-pharmacies end up changing their model. Of course, there will actually be industry associations who may actually chafe at the fact that e-pharmacies are actually eating away into the brick and mortar stores that exist. But I think these sort of clashes end up actually being part and parcel of the offline to online story that the rest of the world is undergoing as of now.
All right, Siddharth, we're completely out of time on the show, but thank you so much for joining us and helping us understand these regulations at this point.
Thank you very much.
On that note, moving on, we kick off a special series called Unicorn Health Check. Over the next few weeks, we aim to create a report card of our most valued startups, delving deep into what's working and what's not. So Shireen Ban is here to take us through the present scenario of unicorns in the country. Shireen?
Now, the Russia-Ukraine conflict and Fed rate hikes that started in early 2022 triggered fears of a global recession. That caused the Nasdaq's worst single-day plunge since the pandemic, resulting in a tech rout which meant that the world's top venture capital funds saw billions being washed off their books overnight. Now, this turned new age tech firms into riskier investments. As the era of cheap money ends, India's unicorns, which were once the darlings of this 13-year bull run, were hit hard. They were driving fast without the necessary brakes, prioritizing growth over profitability. So barring a handful, what do India's 100-odd unicorns have to show for more than $80 billion of investments? Eye-popping losses. If we look at just the top 5 loss-making unicorns, their combined loss for FY22 stands at 18,500 crores, while their combined valuation stands at over 2 lakh crore rupees. We have not included the newly listed new age tech companies and India's most valued startup Byju's, which is yet to report its FY22 earnings. Now, the company reported a 4,588 crore rupee loss in FY21. And this brings us to the core problem facing these billion-dollar companies, and that is cash burn. For the purpose of this conversation, let's take a look at the unicorns that have the worst unit economics. We've picked only the ones that are spending more than 2 rupees to earn a single rupee of operating revenue. Now, during our research, we also found that cash burn of about 1.5 to 2 rupees to earn every rupee was, and I quote, the standard practice at most unicorns in FY22. So take a look at the numbers here in terms of the kind of burn that some of them are seeing. I want to bring your attention to the last column, and that is the revenue multiple measure. A startup's valuation to the revenue it generates is that metric. Simply put, it tells us how overvalued these startups are. ShareChat, which is burning nearly 10 rupees to earn a single rupee of revenue, is valued at 112 times more than its revenue in FY22. But the most overvalued unicorn is open at 195 times its FY22 revenue. And therefore, it's not surprising that of the 50-odd unicorns that have declared their FY22 numbers, only half a dozen, that's right, half a dozen have reported a profit. But why are we seeing these valuations? Well, simply put, the COVID-19 pandemic fueled overestimation and funding for these billion-dollar startups. However, with funding drying up, unicorns are now course-correcting, from growing at all costs to finding profit by reducing cash burn and cutting out all expendable costs. Unfortunately, that's also meant layoffs. Years of hiring ahead of revenue has led to last-ditch downsizing. Over 20,000 jobs were cut in 2022, with Byju's and its edtech peers leading that list with nearly 9,000 layoffs. This year, in January alone, startups have cut 4,000 jobs. However, there is a silver lining. For the first time in 7 years, founders have shown a preference for profitability over growth. A recent report by Innovent Capital shows that 55% of the founders have started to prioritize profitability in 2022 compared to just 17% in 2021. 6 out of 10 founders are now striving to achieve EBITDA profitability over the next 2 years. Well, that's the balance sheet of India's billion-dollar startups. While there is a lot of palpable pain in the system, there's also a silver lining. Founders are now singularly focused on turning black on the bottom line. 8 out of 10 founders are focused on building more sustainable business models.
Well, thanks, Shireen. It's time now for us to take a short break. But on the other side, in our special segment of Future Female Forward, we'll put the spotlight on fashion tech startup Salt Attire. So stay tuned for that and a lot more. Welcome back. Now, despite the fact that Indian women's formal wear market is evolving rapidly, it still remains a highly underpenetrated market with just about 3 to 4 brands predominantly selling when this segment is concerned. Now, in our special segment of Future Female Forward, we put the spotlight on fashion tech startup Salt Attire, which is tailoring clothes best suited for the silhouette of working Indian women. So take a look at this.
Women's share of total employment in India stood at 32.1% in Q2 FY 2022, which is up from 29.3% in Q1 FY 2022, as per a quarterly economic survey. Now, with the rise of women going into the workforce, the demand for formal wear has also shot up in India. However, shopping for office wear is always a Herculean task, especially when it comes to Western clothing, from the issue of size fitting to the lack of variety. Realizing this gap, Deepti Talani conceptualized Salt Attire, which offers formals, business casuals, and workwear for women.
We don't have Indian size charts, right? We work off US and UK size charts, and India mostly UK and Europe size charts. But Indian women are built very different, right? Our body shape is different, our fits, we require very different kind of fits. In terms of sizing, that we saw that there was a big gap. And in general, when I started speaking to a lot of women, asking them where they typically buy their clothing from, so a lot of women said that they actually shop on their trips abroad. Okay, and the irony is that India being a manufacturing hub, even for international brands, we had the capabilities, but the Indian women didn't have that offering. So that's how we identified the gap and launched our pilot.
Apart from its ready-to-wear range, Salt Attire also offers bespoke apparel tailored to customer measurements based on an on-demand manufacturing model at no additional cost.
We built our in-house proprietary tech where we develop basically whatever order comes in based on the measurements. It's all tech-driven. Secondly, even for our sizing, we have developed our own, sizing technique based on Indian body measurements, so that even our standard small, medium, L would fit pretty much 80-90% accuracy. So we offer everything right from your tops, pants, shirts, blazers, suit sets, dresses, and we do have our accessories, also some jewelry there. We are very, very prudent and picky in the kind of fabrics that we source, which should be extremely comfortable because she's wearing it for 10 hours, 12 hours a day. It has to be anti-wrinkle as much possible. We are pretty affordable. Our price points start from around like 1750, 1850. We go up to 4500, 6000. And our average price point would be around 2400, 2300, 2400. Primary customer that we built this for was your 28 to say 45-year-old working woman. We have a major customer coming from Mumbai, Pune, Bangalore, Hyderabad, Gurgaon, Noida. We do get a lot of online orders from tier 2, tier 3.
The D2C startup, which was initially selling via its website and Nykaa, has now expanded its retail presence with 1 store in Gurgaon and 4 in Mumbai. The company is now looking to build an omni-channel platform.
In the past 2 months, our offline is pretty much at par, I would say, with our online. In fact, it's almost taken over. So right now, it's almost like a 60-40, and it should shift to offline in the next financial year. We do plan to get onto the other e-commerce platforms, Myntra, etc., for the reach. And we also are looking at tying up with multi-brand outlets offline also.
Attire has clocked an ARR of Rs 5 to 6 crore in FY 2022 and plans to triple the number by FY 23.
We are bootstrap, and we want to make sure we are allocating our funds correctly. We are also we're making sure we are getting profitable and moving correctly with our unit economics.
The size of women's wardrobe has expanded 2x in terms of volume over the last 5 years, as per a report by Avendius. The global women workwear market is expected to touch $690 billion in revenue by 2024. Asia-Pacific region is anticipated to clock a higher growth rate due to increasing employment opportunities for women in emerging economies like India. Riding on this growth and opportunity, Salt Attire is building its omni-channel presence in urban cities with an aim to make Indian women feel more empowered in the clothes they make. With camera person Lakshman Singh, Aishwarya Anand for CNBC-TV18.
And it's time to take stock of all the deal action from the startup world. This week saw 11 deals valued at $191 million. This, according to Venture Intelligence. Let's take a look at some of the key deals. Insurance Deco raised an additional $150 million as part of its Series A round from TVS Capital, Investcorp Group, Attire Ventures and others. HBL Power bagged $18 million from Tonbo Imaging, while drone maker Garuda Aerospace got $17 million from Spiti Capital, Opgro Ventures and others.
That's not all. AI-powered employee service desk startup Resolve raised $11 million from SIG Venture Capital, Xfinity Fund and others, while venture partners and Sovereign Investments, among others as well. Finally, Hippo Video bagged $8 million from Dallas Venture Capital, Alpha Wave Global and others. Now, according to Venture Intelligence, the startup ecosystem has seen 191 deals worth $1,040 million this year.
On that note, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Presented by HSBC. Knowledge Partner, Deloitte.